So, hi everybody. Again, it's really a pleasure to be here. It's an honor to be with Ramon and Bruce. To me, you won't get any finer off material there is, and especially with the other as well, Dr. Gary and David. Those guys are the top of the top, and I'm just the cleanup hitter. So, I mean not cleanup, the on deck person for these people. These guys are top. I want to approach something a little bit different. My approach a little bit different in Wyckoff, and I started out teaching and I taught structure as far as buying climax, selling climaxes, in those nature. And I started doing that, I think I was the first one online to do that in '95 with AOL chat room. I still do a day chat room, but I've gotten away more from the classical Wyckoff patterns of buying climax, selling climax, and things of that nature. I'm a very big believer in spreads. Rome and I have talked, and one day I'm going to do a talk with them on spreads and the NASDAQ, S&P, and Russell, which is really a fascinating talk. We'll get there one day. But more importantly, we don't see the buying and selling climaxes like we do, but we look at them sometimes in hindsight. And a lot of Wyckoff stuff is hindsight, but because there's some actions that lead to the next action. Having said that, volume and price are the only two indicators that are alive. So everything else you see is a lag indicator, RSI, and things of that nature. That's why Wyckoff to me is the best. It's the best indicator because of that reasoning. Okay, so I am not going to repeat Roman. I'm not going to repeat Bruce, Dr. Gary, because you know what? You know the areas and points. You know the areas and points that go on. So I want to add something different to this group today. Okay, as you know, the market, the Russell index, has more stocks than any of the indexes. We have the Dow 30, S&P 500, with the NASDAQ 100 1000, and the Russell. So to get a broad situation of the market, the Russell is the one that tells you more of the breadth of the markets. It's very critical. And the Russell weakness, I wrote my newsletter, the Russell weakness always to me was something that was a telling sign that ultimately that we would fail. Now, I'll tell you something interesting, you're probably shocked. I was a Ford trader at the Merc, and I was in the 487. And the market started to break. The market was down like 10 points. At that time, the Dow moved around 20 points a day. 20 points a day. This particular day, the volatility picked up beforehand. The market then broke, and they made a flippant comment to a Japanese reporter that's on the floor, said, "Oh, we could be down 500 points today." It's a joke. The next day, when the market was down 500 points, I was interviewed. And I said, I was joking. I didn't mean it, but it just felt heavy. Why did I bring that up? That day, at the end of the day, brokerage firms started taking out money. There was a run on the banks. There was a situation in which people freaked. Unfortunately, people jumped out of windows. Unfortunately, people got to the point in which it was horrible. The breakthrough we see now, the panic we see now, is nowhere near what happened in '87. It's hard to believe. But every breakthrough we had in the past was fixable. Lowering interest rates, adding liquidity to the markets. So that is something that is very important. So as far as it goes, I'm going to do something a little bit different today. I'm not going to go over numbers, but I'm going to tell you how this week was manifested in itself. Okay? Here we go. I'd like to add something unique to Roman's group because I love this group. I think it's fantastic. So obviously we start with larger time frames, okay? But let's just talk about the market in general, just real quickly. So obviously, I don't know if you look at a monthly chart, we look at a monthly chart and we work from a higher time frame to lower time frame. If you look at the market this way, this could just be a spring of the market, right? Okay. Or this could be preliminary supply. in a buying climax. But when you look at the monthly chart, bad as it seems, could be. Having said that, I'm really negative overall the market, but I think we go back halfway back. I think Dr. Gary mentioned 2830 area, which, and I'll show you that as well too. But I don't want to go over what they said. I want to add something different to this group. So this is on the monthly chart. We go to the weekly chart, obviously. We see something different. We see a market, and this is very interesting. Bruce mentioned this, and I was in it for all the thing, but we have this market. With Wyckoff, we just don't draw one line. We draw reverse trend lines. We take our parallel channel, and voila, we get here. Great channel. I'm worried about when the market's railing, I'm more worried about the upside than the downside because we don't use this as demand and supply. We use our horizontal lines, but we use it as a reverse trend line. When this market becomes more overbought, we do not consider this consider a breakout. We consider that a more overbought line, more danger zone. So if you have a point and figure of 30 of a stock and the stock goes to 36, as much as that stock is more bullish because it's higher, it's also more overbought on the point and figure chart and can come down. Obviously, Wyckoff used point and figure chart very nicely, and that's one of the ways we get our count from point and figure and reverse trend lines. So a point and figure chart that's overbought and the market that's over the sign-wise is a danger area, not a breakout. Obviously, Bruce is one of the best in the business point and figure chart, so I bow my cap to him. So I'm going to show you change of behavior. So we talk about reaction highs and reaction lows. In this chart, Wyckoff, we believe in Wyckoff that price action incorporates the fundamentals of the market. In this case, the market failed to do that. It's unusual. There was no Wyckoff behavior of a buying climax here. In order to have a buying climax for Wyckoff, we need to see preliminary supply and a buying climax. So I know we look at structure, and as I told you, I look at structure differently. There is no preliminary supply here, none. Okay, this market. Point and figure chart by Bruce was perfect. Okay, but there's no, because of buying climax, the widest range, largest volume. We don't see that. This is horizontal. This is vertical absorption. These little breaks are shakeouts. One of these breaks was the Iranian thing, then the missile, then the killing of the guy. We heard about this virus in January. The market then proceeded to break. This was January 27th. It was the week that President Trump made the last not that big of a deal, not that big of a deal. But the market sensed something was happening. But the market did not look at that as anything important. Now, if you want to say it's preliminary supply, it was different because the range was not that wide now, relatively speaking, but it was a relatively wide week considering, but not anything that it would be anything greater than these breakouts here. Anytime a market breaks, people say, pop, pop, pop. And then the market, preliminary supply, the market's sharply higher. So eventually, you're going to get a squirrel's going to find an acorn. Once in a while, you're going to do that. The Joe Granvilles, the Abby Cohns, all have these great one-time things. They're great people, but that's what happened. Market went up new highs. As probably Dave will mention to you, the market went up here, a good bar. Then we had to go short in upward thrust. Upside movements. Not a big deal because you wouldn't say this is a bearish bar. But here's what's key about this whole chart. And I'll show you more clearly in the chart. This market has right here has we mark high volume areas, and David is phenomenal at this. This area here, we mark areas with stopping action or markup areas. I mark this bar right here across. Once this market started to break an increasing volume in price range, we have two things. We have a shakeout, or we have this area's distribution. We assume shakeout initially until we see the reaction of the markets. I mark this area. In a shakeout fashion, it acts as a spring of the market. It acts as a spring to the market. This obviously is not in the spring position. We break, market breaks back down, But why does the market have light volume here? The light volume here is because the longs are already washed out. The early longs get washed out here because the last longs are the first ones to get out. And the market continues to break. We see I call this a selling tail, a market that goes up that breaks. So I teach this in my mentoring thing that I do. So the market that goes back, it's a selling tail to the market. Since it's not a shakeout, it's an area that's weakness. Market breaks. So mid-range close, real good close. That's kind of a shakeout. That's a great close, great volume. Shakeout, we're going here. The problem is this was not an area of a spring type of formation area to Wyckoff. It was more of the weakness in the market. So this buying of the market was the composite operator buying back when he sold to the funds and specs. When the funds and specs buy, they buy new highs. They buy new highs. They sell new lows. They're momentum traders. The composite operator, like a Warren Buffett, let's say, in the market-wise, he'll buy a stock at 30. He won't pay 38 for the stock. He'll wait to buy back to 30 and buy his shares. If the market goes above 38 and then goes to 40, what does he do? What does the market do? Either he caps it if he thinks it's overvalued. And if he does not cap it, the funds and specs buy it. That's why you see increasing volume when markets make lower lows. This is why, and probably Dave will explain it to you more, this is why springs and upthrusts are so effective in markets. It traps the transfer risk. We then break. This becomes our reaction. We don't really mark this in the sense of a buying bar because the market really didn't buy, but we'll mark it here if you come off the low. Breaks. This area here, I'll show you the NASDAQ a little bit, is somewhat of a labored break to the market. The market's making new lows, but not excessively to the market. So I don't want to spend a lot of time with this chart, which I did, but I want to go to a different chart, the daily, because most of you don't look at weekly charts in the S&P, for example. Again, we have our overbought line. I'm going fast because I want to get this done. These are shakeouts. These are shakeouts. No follow through to the market. Extremely important to understand what they are. Market takes us here. We draw a line across, and we start to get a point in which the market now has an overbought line. This is where my discussion really begins in earnest. We have a market shakeout new highs. One of the things, and Roman has told you, as I listen to Roman, springs have to make new highs. If springs do not make new highs, that means that they're making a lower high, and eventually they'll make a lower low. This market does, spring-wise done. We know the springs can have a one-bar spring, a spring of a previous bar, or we can do that as a ICE support bar. Look here, the market is overbought. This does not give us the right to sell the market short because there's no distribution. A market that hovers this reverse trend line stays very bullish. Look what happens. The market starts to pull away. The slope we're pulling away from this line. It's becoming less overbought, but a little bit negative because the market cannot keep up with the slope of the rally. So this bar right here was a very key bar to people. This was a bar that even though the volume was a little bit was not that the script here, but it's where the market started to mark up from. It was a spring of the markets. This spring made a new high. Very good. This bar right here is a very good bar, or potentially a good bar, because it sprung the market here, another spring. Okay? What does that spring have to do to the markets? It has to make a new high. Otherwise, if no new high, what happens? Down. No new high, down. This market then comes here. This was the line of the sand. This market had to react. Otherwise, all these longs start to liquidate. This was Friday close. They started to sneak down prices. Not so bearish, but the market has to make a new high. Remember, I talked about springs. Have to make a new high. This was the gap. You make your decision. Is that a spring gap, to buy the spring? Or is that a gap in which it's weakness? Well, obviously, I don't think anybody, Wyckoff-wise, would buy this. This just told you, flip over all the cards You know what's happening. You know that this area being accumulation is now distribution. The game is over by this one bar. This bar takes out this bar right here as well, and the game is over. Now, Wyckoff looked for secondary tests, but the market was in the ready position. So this, since we had distribution here, this became a foregone conclusion that the process was going to begin in earnest. The news was not that bearish up here, because we don't top out unnecessarily bearish because the market was higher. But as the market started to mark down, we started to get the news about the virus. But the market here, we knew about in January. The market did not top out until February 20th. So I mentioned to you the market was lagging behind. This is unusual for the market. You usually see this foresight, but I'll explain to you how we can tell how the market broke from another market. This market then broke. Okay. Once this market here, we got to make a decision. What I'm trading for, they would say, Gary, what do you think of the market? If I would say, I think we're going higher or lower, get out. I have to have a good conviction. The question is, if you were long and the market did this, would you put that long position on? The answer is no. So the market has the opposite effect to the market. Again, as Roman has mentioned, after result, I'm very big on after result. Obviously, this increasing volume, small range, is stopping volume temporarily. It's when the composite effort buys back his shorts that he sold. He buys it back with a huge profit. The market is weak in position. I look for an up thrust right here. If I get short, my stop above here. Market break. You start to move down, down, down. Area-wise, this market here is the reverse trend line to the market. And what do we see? We have to see that the losses are not as prevalent as far as wide bar action. I have a thinking when I look at trading for, when I see high range or low range, low close, high close, low close, there's a battle going on, change of behavior. This market should have got ran big time. The market went down in light volume, or not light volume, but not heavy volume. The longs are out. Created this rally. Okay, it's extremely, extremely, extremely important to the markets. Extremely important to the markets. Now, as this is the left-hand side of the market, phase A, and now we're getting to this more second phase. I call it the right-hand side. We should see less volatility, even though we have volatile days, but less volume because the market's not above resistance areas or under support areas, so we'll stay there. If you look at 3,400 as our high, if you take 2174 as your low, it comes right around 2,800, so about halfway back. Okay. If we don't look at one number with Wyckoff, we look at areas. Here to here, this area is where we look for retest, and I think we're halfway back. Okay. So that is that. Now, I don't know how much time I have, but I want to go over the Russell with you real quickly, and I want to show you something. Hopefully one time with Roman we'll do this. I believe the NASDAQ leads the S&P, either up or down. NASDAQ is a market that's more speculative in nature. And that way, when people feel good about the market, it leads with the NASDAQ markets. This market is obviously very vertical. Vertical markets end very badly. .com, 2018 December, they act badly. You say, well, Gary, where's the distribution cause? Because this market is such a fervor upside to markets, okay, such a fervor upside, it breaks back down to find value. So now this market was very, very bullish. And remember, February 20th was the high of the market? This spread leads. This high was 14th. It started heading down. Usually the spread's about 2-3 days in advance. Okay? And now we're in this trading range, market-wise, nothing going on. I watch it. So, very important, that leads. Let's do the S&P. Let's go through this real quickly. And I'm going to show you something great. Let's just start with our NASDAQ. Okay? NASDAQ, if I can get better things. The NASDAQ here, obviously, is vertical. if you want to say this is if you want to say this is a preliminary supply buying climax, okay, then everything you see here is that reason. So you only tell the buying climaxes afterwards, okay? This is the reaction high, reaction low before the high. So reaction low before the high. Wyckoff describes this, or retest of breaking the ice. The market then gets this point. This is a perfect sell to Wyckoff. This is so classical Wyckoff that I can't even imagine that. Okay, this is weakness. That begets weakness. Perfect test, not a shakeout. The volume increases high here because the last longest get out and stopped out. It doesn't get any more perfect than this. Where's your sell? If you want here, you can sell the breaking of the ice. If you're a little more conservative, right, you can wait, you can say here, but your stop loss has to be above here. Wide stop loss, I agree, okay? Or you wait for a secondary test. But the wheels are in motion, the campaign is in motion to go lower. Okay? Also, NASDAQ squeezed a little bit down, shortening of the downward thrust led to this rally, trading range. So this market really had the big run up. So keep this chart in focus in your head. Okay. We then get to the point in the S&P, the second of the two markets. If it's very hard to imagine that we talk about the S&P, but the NASDAQ strength was higher to the market. NASDAQ's higher strength to the markets. So, real quickly, we took out this December 18th. I'll show you about strength and weaknesses. December 18th low. So the market's in a quote-unquote spring position, but really from weakness, so that's not really that great. December 18th low. Okay, remember that, December 21. Let's go back to the NASDAQ. Okay. Let's go back to the NASDAQ. I'll talk about strength and weakness of markets, how you can tell if this market was weak. Where's December 8? Where's December this chart? Here it is. Which market is stronger? This market only took out last year's low, the 19th. This is where the same spring that came in the NASDAQ, S&P, look how far we are in the NASDAQ. I'm bearish overall, but this shows the strength of the NASDAQ, right? Still. Now, this is the NASDAQ. Real carefully now. Look at my Russell Index. Russell Index was classical Wyckoff. When I was on the trading floor, I met a guy that owned an island, and he would only trade markets that were obscure. And he would tell me that he's not going to know as much in the S&P as Bill Gates or whatever these guys. But if he can go to a market that's a little more obscure, he can understand it just as well as all of them. So look at the structure of the Russell. It's so perfect. And sometimes we get perfect Wyckoff, and sometimes we just have to read the tape. We don't see the exact Wyckoff. So here the Russell Index gets to the point. I'm making you dizzy. I'm sorry. Here the Russell gets to the point where the market makes the high. This is that December 18th. This is that. I'm sorry. This is the 18th low. Here. Remember, the NASDAQ never went to this low. The S&P had a spring of this low. Look at the Russell. The Russell is the secondary stocks that are more breadth of markets, and yet they destroy the Russell Index. That shows you the bearishness of the markets. The one that's speculative also, that feeds into the NASDAQ products, getting hammered. So you have to look at that. Now, when the market was making new highs, right? The Russell and the S&P, NASDAQ and the S&P were making new highs. This market, I pointed out in my newsletter, this market never made new highs. This market maintained the weakness in the market. This was perfection. So if you want to look, so again, Wyckoff schematic wise, normally you'd say this would be preliminary supply, but then the buying climax would make a new high. This to me was the buying climax because the market was weaker, even though I'm not considering a buying climax, but in my head, it's a weaker market because we didn't make new highs. This was the sign of weakness. preliminary. Now, I don't label things like that all the time, but in my head, weakness, buying climax, boom. So the Russell was actually the weakest one all the way through this whole process. Eventually, markets that keep going up vertically will break. When the market breaks eventually in shakeouts, they're in an acute situation. Bad earnings, the president trips, he broke his leg, whatever. Those are acute situations, market goes back. When you have a chronic situation, like you have now, this is where you tend to have trends that continue to occur. This was weak all the way through. This was all distribution to the market because the market never took out that high. Remember, springs have to make new highs. I'm very big boom that way. So that is so critically important. The Russell, now not many people watch it. I'm going to assume that you're all going to watch it now, hopefully, but it's so critical in your analysis. Okay. So let me show you another reason why the market broke. Gold is a flight to heaven, flight to haven when things happen. Okay. Well, remember when the market started to go up and the market was making new highs in February. Well, something happened on the road to the market. The gold market started to accumulate in November. This gold market rallied. Gold knew something. Now you can look at that as far as that goes. Okay. But the problem becomes, is that not the problem? The market sniffed something here. Sometimes markets sniff something. We don't know what the event is, but the markets have a good way of knowing it. So from an S&P standpoint, no, but from a metal standpoint, this market already started to move up. Okay, when the time February 20th came, the market was right here. The market anticipated, why did gold rally? Everyone's looking at, I remember people asking me, why did gold rally? I said, there's something out there. Gold was the first thing to react on 9/11. Gold is one of the quickest. If you see gold moving, it's something is happening with gold. I don't know why, but it just so happens that gold seems to lead. Another market that leads is the bond market. When did the bond markets go interest rates? So when there's a flight to quality, they go into the bonds because they're guaranteed by the government. Okay. Well, look what happened to the bond markets. When did the bonds start to base and accumulate? That's interesting. The bond market started in 2000, and this year forms went up a trading range. The market was already moving up in January, like the quality into bonds. My point is, if you look at all the markets combined, you will see that you just have to look around other markets. You saw chinks in the armor to the market. You saw the market acting very differently. So to me, bonds and the gold will tend to lead the indexes many times. Gold, for some reason, is a situation in which gold gets to the point in which we lead markets, because maybe it's a situation where that lead other markets where it's easier to move gold around than it's move 500 S&P stocks around. So I didn't go a lot in technical analysis, even though I did drawing away and where the market actually broke out from, because there was a change of behavior on that Sunday night. But more importantly, I want to show you why the market broke and how you can tell clues to the market. Now, does it always work that way? No, and everything is different. This break is much different than everything else, but you could see signs, if you're very observant in Wyckoff structure, in Wyckoff behavior, that the overbought line became coming off the line. And the market also got to the point to where we saw the Russell being weaker. So there was a lot of clues to the market that allowed that to happen. Okay, which allowed that to happen. So I took up enough of your time. David and Dr. Gary and Roman and Bruce obviously do the heavy technical lifting. I do as well, but to make this even better, more enhanced for everybody, I want to see the situation in which I wanted to show you more of a understanding of the weakness of markets that led to the break. Having said that, I think the market goes into a trading range. I think that we have more volatility on days. I think I like Bruce's area that he mentioned about 18,000 in the Dow. I think that's very doable. I think the halfway point between 2775 is something that's also something that's very, very important. Roman, if I could have 2 more minutes, I want to show one more chart, okay?
Absolutely, yes,
Like,
go for it.
guys, you're gonna be fast. You're gonna this. So you're gonna have to put another dollar in the jukebox, everybody, to get this information. So I'm gonna double your pay. I'm gonna double your admission today. Roman, can we do that? Can we double their admission for them?
Absolutely, but it's a free event, but go for it.
So make sure you double them, and everybody, you're gonna be charged double. Roman's gonna collect this doubling to zero. Okay. Okay. This is crude oil. Obviously bearish. Bearish because of recession. Watch. This market had a little buy off the low. Not much, not bullish. But we have to judge volume in the area. Mark comes back down here. The volume kind of dries up. Not a bullish day. Not a bullish day, but not as bearish as you think. Wider range, less volume. Not a big deal. But I want to mark this because something is happening. Don't know what. It looks lower to me. It happened. I draw my line across. Look what happens here. Now, some people, the market should go higher. Look over here. Small range, increasing volume. For first results. Lack of demand. Boom. Also, next retest. This was a market was this is what I call bag holding to a great degree. Market had increasing volume, small range. It did not go lower. Some was bag holding. I call it stuffing. Then they come up with the news with blah, 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 okay? This area, though not bullish per se in the sense of to get long because you're against trend, but you had to be out of shorts because this was bag holding to the market. Increasing volume, after versus result. So that is really something, after versus result is something I work on constantly with students because I think it's something that is one of the, because demand and supply can happen anytime in the market. It depends on where it happens, what's important. Effort versus results is the most important thing to me, effort result, and that cause and effect, that could be a 15-minute chart or it could be 10-year charts. So crude oil, it's stopping action, stuffing action here because of the volume relative to price. And I'm all done.
Gary,
I want to thank you.
that was so great, and I just love your analysis. I love your thinking. And you just have to kind of adopt to Gary's ways of interpreting the market, of how he goes through the chart. And there is so much information, so many insights, into the tape reading. Gary, thank you so much. I also want to mention that you just did a tape reading class for us in January, so that is still available on our on-demand site. So, if you would like to see Gary's work, you could find it there, or ltgtrading.com, if I'm spelling it correctly, Gary. And I know that you have a bunch of stuff there.
Yeah, I'll just put up there for you guys. I mean, this is all about you guys and stuff, not about me really. And come here. I'll give you a 2-week free to my newsletter and 1 hour free webinar. So just come to here if you want to come. As far as that goes, and more than welcome. I have to tell you, in the bottom of my heart, Roman asked a couple of days ago, and he put together this thing. I don't know how he did it, but he put together great people, including himself and Bruce. I guess Bruce has to come with him, and David and Dr. Gary, one of the finest people in this industry. And to put it together and to get the amount of people that came to this thing, which is astronomical, short term on a Friday, when people are, it's unbelievable tribute to you people that are here because you are taking your time to learn a skill. And I think as we go more and more into this scary time, learning a skill of Wyckoff is the best investment that you guys will ever make in your life if you're interested in trading. There's no better than what is going on right now to learn Wyckoff. Because this is, even if you don't trade, to understand markets, Wyckoff style, with Bruce and Roman and everybody else here, to learn, you could pick your style, to learn these things. You are learning the best from the best of the best, but be more importantly, something you could never take away from was education.
Gary, thank
And
you so much for these words. And, all of the speakers who are here, just really good people, and they just reacted so fast, and everybody was excited. So I'm just excited that we are having such a great event. And thank you for coming. Thank you for showing, your insights on the tape reading, on the markets. And surely we would love to see you in the future. Thank you, Gary.
I'd rather see the future than the pasture. Okay, just a little joke. Not being underground, not being underground, not being underground. Seriously, everybody, please be safe, okay? And be very careful out there. Stay inside. Take Bruce's and Roman's classes, and take some of the people that are there. You cannot go wrong with any of that stuff.
Thank you, Gary, so much.